Hi, everyone. I am William. Welcome to this channel and joining me here. In our interconnected global economy, currency risk is no longer a niche concern for massive multinationals. It's a mainstream financial reality for any organization that earns, spends, holds, or invests in a foreign currency. A foreign exchange audit is the critical tool that provides assurance over this complex and often opaque area. It's not about predicting the euro or the dollar. It's about rigorously examining the framework, controls, and decisions that protect the organization from adverse moves. Today, we will move from theory to practice. We will deconstruct a modern FX audit into its core components, providing you with an actionable blueprint. We will cover the strategic imperative and core objectives of the audit, a deep dive into the 3 lines of defense model for FX risk, the 4-pillar audit framework, from governance to financial reporting, practical testing procedures and common failure points, and finally, how a mature FX audit program delivers strategic advantage. Whether you're in audit, treasury, finance, or governance, this session will equip you with the knowledge to ask the right questions and build a more resilient organization. Why dedicate significant resources to auditing foreign exchange? The stakes are extraordinarily high. Unmanaged currency volatility can erase the profit margin from a major overseas contract, inflate the cost of debt or imported materials, create severe earnings volatility, shaking investor confidence, lead to catastrophic losses from speculative or uncontrolled trading. The primary goal of an FX audit is not to judge market calls, but to provide independent assurance that the process for managing this risk is robust and effective. We focus on 3 core objectives. 1. Risk management assurance. Are our economic exposures accurately identified, measured, and hedged according to a defined risk appetite? Are we hedging risk or inadvertently creating new risks? 2. Control and operational integrity. Do we have strong, verifiable controls over the entire FX transaction lifecycle, from deal initiation to settlement? Are we protected from error, fraud, and unauthorized activity? 3. Compliance and financial integrity. Are we complying with internal policies, regulatory requirements, and complex accounting standards like IFRS 9 or ASC 815? Are our financial statements presenting a true and fair view of our FX positions and hedge effectiveness? An FX audit, therefore, is a holistic review of strategy, operations, and compliance. To understand our audit scope, let's use the 3 lines of defense model. First line, Treasury and operations. This is where the risk is owned. Dealers execute hedges, operations staff process settlements. Our audit tests their adherence to policy and procedure. Second line, risk management and finance. This group sets the policy, measures exposure, calculates hedge effectiveness, and monitors compliance. We audit their frameworks and oversight activities. Third line, internal audit. That's us. We provide independent, objective assurance to the board and audit committee that the first and second lines are functioning as intended. Our audit interacts with and assesses all 3 lines. We are not duplicating the second line's work. We are auditing the entire risk management ecosystem. Our audit is structured around 4 interconnected pillars. A failure in any one can collapse the entire risk management structure. Pillar 1. Governance, strategy, and policy. We start at the top. The FX policy is the cornerstone. We scrutinize it for board approval and review. Is it formally mandated and reviewed annually? Clear risk appetite. Does it state whether the organization is hedging defensively, to eliminate uncertainty, or more actively? Defined hedging objectives. Is it hedging cash flows, transaction exposure, balance sheet values, translation exposure, or net investments? Authorized instruments. What tools are allowed? Forwards, simple options, vanilla swaps. Are complex, leveraged derivatives explicitly prohibited? Counterparty and credit limits. Which banks can we trade with, and what are our exposure limits per counterparty? Delegation of authority. Who can trade? What are their dealing limits? Who can approve exceptions? We interview senior management to see if this policy is a living document that guides daily decisions. Pillar 2, risk identification, measurement, and hedging strategy. You cannot hedge what you cannot see. We audit the process of exposure identification. Forecasting. How reliable are the cash flow forecasts from business units? Is there a formal, rolling process for identifying transactional exposures 12 or 18 months out? Exposure aggregation. How are exposures netted? Can we offset a euro receivable with a euro payable, or does policy require gross hedging? Hedge strategy and effectiveness. We examine the documented hedge rationale. If hedging a forecasted sale, is there a high probability of occurrence? We test the methodology for assessing hedge effectiveness. Does the hedge instrument actually offset the risk? Use of options. If options are used, we review the strategy for purchasing puts, calls. Are premiums justified? Is there a written rationale for the strike prices and tenors chosen? Pillar 3, execution, operations, and controls. This is where theory meets practice. We conduct detailed transactional testing. Deal execution. We select a sample of trades. Were they executed with pre-approved counterparties? Is there evidence of competitive price discovery? We compare the dealt rate to the interbank market midpoint at that time. The golden rule, segregation of duties. This is non-negotiable. We verify that the front office, dealing, is separate from the middle office, confirmation, risk measurement, and the back office, settlement, reconciliation. A single individual controlling this chain is a critical failure. Confirmations and settlements. Are electronic or paper confirmations received from the bank and matched to internal records the same day? Are settlements, the actual currency movements, verified independently? Reconciliations. Are all outstanding forward contracts, swaps, and options reconciled monthly between the Treasury management system, bank statements, and the general ledger? Pillar 4, accounting, valuation, and reporting. This ensures the financial statements reflect reality. Complex accounting standards. We verify compliance with IFRS 9 or ASC 815. This is highly technical. Are derivatives marked to market through P&L or OCI? For hedge accounting, is the documentation, the hedge relationship, risk objective, and effectiveness method completed at the inception of the hedge? This is a frequent and costly finding. Valuation. Are derivative valuations sourced independently? Does finance obtain the mid-market valuations from a system or a third party, not from the dealing bank's confirmations? Management and board reporting. Do reports clearly show the exposure dashboard, hedge coverage ratios, mark-to-market gains, losses, and effectiveness testing results? Is the board's audit committee informed of the risk profile and any policy breaches? How do we gather evidence? Through a combination of substantive testing, selecting a sample of trades and tracing them from forecast to settlement. Analytical procedures, reviewing P&L volatility, calculating the cost of hedging programs, and benchmarking rates. Data analytics, using scripts to analyze all trades for patterns, e.g., always trading with one bank or always trading at the end of the month. Reperformance, independently testing a hedge effectiveness calculation. And what do we find? Here are the classic red flags. Overhedging or underhedging, consistently hedging 120% of an exposure, speculation, or only 50%, inadequate coverage. Stale policy, a policy that hasn't been updated post-Brexit or during recent market turmoil. The missing hedge documentation, a multi-million-dollar cash flow hedge with no formal IFRS 9 documentation, jeopardizing the accounting treatment. The lone wolf treasurer, A single individual handles everything, a catastrophic control failure. Performance-linked hedging, adjusting hedge ratios based on a view of where the currency is headed, violating a policy of risk elimination. Off-market trades, unexplained deals executed at rates significantly different from the prevailing market. So what is the ultimate return on investment for a world-class FX audit? It transcends compliance. A robust FX audit program protects profitability and cash flow. It ensures hedging strategies are sound and operational losses are prevented. Enhances credibility. It gives the board, investors, and rating agencies confidence in the organization's risk maturity. Optimizes costs. It identifies inefficiencies in execution and banking relationships. Prevents catastrophe. It is the final safeguard against rogue trading and control breakdowns. Inform strategy. It provides clear data that can influence business decisions on sourcing, pricing, and geographic expansion. In essence, it transforms the Treasury function from a reactive cost center into a proactive, strategic enabler of business objectives. It allows the organization to navigate global markets not with fear, but with confidence and control. I challenge you to view your next FX audit not as a regulatory burden, but as a strategic health check, a catalyst for building a more agile, resilient, and financially sophisticated organization. The goal is clear: to ensure that currency risk is managed with the same discipline, insight, and strategic focus as any other core business function. Thank you for your attention. If you found this channel is useful, please do subscribe and share it out with your friends, colleagues. Thanks again and have a great day ahead.